On June 12, 2026, SpaceX went public. Not just public, it completed the biggest IPO in stock market history. $75 billion raised, a valuation of $1.75 trillion. The largest single-day capital event the world has ever seen. In the weeks before that IPO, the stocks around it were already moving. Rocket Lab up 300% year-to-date, Intuitive Machines up 88%, Viasat up 339% over the prior 12 months. Most investors missed all of it. And here's the part that surprises people. The biggest gains were not even in SpaceX. They were in the companies around it. Not because the information was hidden and not because the companies were obscure, because the mental model most people use for space, government program, science project, decades away from being real, was built for a different era. And it has been quietly, systematically wrong for the past several years. In this video, we're going to break down what changed, why the space economy is now a legitimate investment thesis, what the SpaceX IPO means for the sector going forward, who is actually winning right now, and how to think about it after a move of this magnitude. To understand why this moment matters, you have to understand what changed. For most of the 20th century, space was a government domain. The economics were simple. It cost an enormous amount of money to get anything off the ground. The timelines are really long, and the payoffs, if any, are diffuse and hard to monetize. NASA, the ESA, Roscosmos, these were national programs. They were funded by taxpayers. They were measured in decades, not by quarters. Then something broke. In the 1990s, launching 1 kilogram of payload to low Earth orbit cost approximately $65,000. By 2024, SpaceX brought that figure down to around $1,500 per kilogram on a Falcon 9. That's not a 10% improvement. That's a 97% reduction. When the cost of access to space drops by that magnitude, it doesn't just make existing missions cheaper, it makes entirely new business models possible. Satellite internet, previously uneconomical at scale, now becomes viable. Earth observation with revisit times measured in hours, not weeks, becomes a commercial product. In space manufacturing, lunar logistics, communications relay networks, each of these goes from theoretical to actionable when launch costs collapse. The global space economy was valued at $626 billion in 2025, according to Novaspace's 12th annual space economy report. Multiple forecasters, Morgan Stanley, Bank of America, and McKinsey, project it will cross the $1 trillion mark before 2030. The direction is not in dispute. The debate is how fast. The growth is concentrated in satellite communications, launch services, and Earth observation. In 2025, satellite manufacturing grew 70% year over year to $20 billion. Launch services grew 30% to $9 billion, and the underlying driver is the same across all of them. Commercial applications that simply didn't exist a decade ago. Space stopped being a destination, it became infrastructure. The SpaceX IPO did not just create a new publicly traded company, it changed the gravitational field of the entire sector. On June 12, 2026, SpaceX listed on the NASDAQ under the ticker SPCX at $135 per share. At the time of the IPO, the company raised approximately $75 billion, which is a figure that, following the exercise of the greenshoe option, reached around $85.7 billion in early trading. Either way, it's the largest IPO in stock market history by a significant margin. At IPO pricing, SpaceX carried a valuation of $1.75 trillion. Following the early trading sessions, that figure moved above $2 trillion. The exact number will depend on when you're watching this, but the order of magnitude doesn't change. To put that in context, at either valuation, SpaceX is larger than the market capitalizations of JP Morgan, Chase, Walmart, and ExxonMobil combined. Elon Musk reportedly pushed for up to 30% of shares to be allocated to retail investors, at least 3 times the typical IPO retail allocation. That decision is not incidental. It reflects a deliberate effort to build a broad retail anchor investor base that is difficult to short and resistant to institutional pressure. When an asset with a $1.75 trillion valuation enters public markets, a number of things happen automatically. First, index funds and ETFs that track the NASDAQ will eventually need to own SPCX, and that can trigger passive fund demand at scale once index eligibility and formal inclusion criteria are met. Second, every analyst who has been covering adjacent names, Rocket Lab, Intuitive Machines, AST Space Mobile, Viasat, now has a benchmark. The entire sector gets repriced relative to SpaceX, and that repricing was already underway in the weeks before the IPO, which is why the names mentioned at the start of this video were already up substantially before June 12th. Third, the SpaceX IPO puts the space economy on the radar of institutional investors who have been waiting for liquidity. Private equity and venture funds that hold space assets now have a clearer path to valuation. The IPO is not just a capital event, it's a legitimization event. SpaceX is not one business. It is at minimum two. It's a launch company and a satellite internet company. Starlink, as of 2026, operates more than 7,000 satellites in orbit. It serves customers in over 100 countries and has become the dominant provider of broadband connectivity in underserved and remote markets globally. The value of Starlink alone has been estimated by analysts in the tens or even hundreds of billions of dollars as a standalone entity, figures that would rank it among the largest telecom companies in the world. It's bundled inside the SpaceX valuation. That bundling is part of what makes SpaceX IPO so significant. Investors are not just buying a rocket company. They're buying the company that controls the most comprehensive end-to-end space infrastructure stack currently in existence. The SpaceX IPO is the headline, but the trades that actually moved in 2026, the names where investors made money, were in the surrounding ecosystem. So let's go through them. Rocket Lab is, at this point, the most direct SpaceX competitor with publicly traded stock. It operates with the Electron rocket, a small lift vehicle with over 50 launches completed, and is developing the Neutron rocket for medium lift missions. It also has a growing space systems division that designs and manufactures spacecraft components. In Q1 26, Rocket Lab reported record revenue of $200.3 million, up 63.5% year over year. The company's backlog reached $2.2 billion. On June 22, 2026, Rocket Lab joined the NASDAQ 100. The stock has returned approximately 300% year-to-date in 26, moving from roughly 27 in January to over 109 in mid-June. The gains reflect a fundamental re-rating. This is no longer a company valued on potential. It's being valued on revenue growth, backlog, and execution. The risks are real, guys. Rocket Lab is not yet consistently profitable. Neutron development carries execution risk, but the backlog, the NASDAQ 100 inclusion, and the trajectory of revenue growth give it a different profile than a pre-revenue bet. Intuitive Machines builds spacecraft and operates lunar transportation services. In February 24, it became the first American company since Apollo to land a spacecraft on the moon. It has since completed a second mission with the third planned for late 26. In Q1 26, revenue came in at a record $186.7 million. The company's backlog stands at $1.1 billion, anchored by NASA contracts and growing commercial relationships. Lunar is up 88% year-to-date in 26. Analysts have set price targets as high as $75 against a mid-June price in the low $30, citing the lunar logistics franchise, NASA contracts pipeline, and the broader commercial moon economy that the Artemis program is beginning to catalyze. The key variable to watch? Contract renewals, and NASA budget trajectory. Intuitive Machines is deeply tied to government spending priorities, guys. If NASA's lunar program faces budget pressure, that risk flows directly into the backlog. Viasat's story in 26 is a turnaround, guys. It's not a growth story. The company has been under pressure for years following challenges with its Viasat 3 satellite program. The stock was trading below $15 at its 25 low. What changed? The Viasat 3, America's satellite, partially recovered functionality. The company resolved a series of operational headwinds, and investors reassessed a business with $4.6 billion in annual revenue, a $4.1 billion backlog, and positive free cash flow for 5 consecutive quarters. Over the 12 months through January 26, Viasat delivered a total return of approximately 339%. From the 2025 lows, the recovery has been substantially larger. The stock as of mid-June 26 trades around $70, against a consensus analyst price targeted of approximately $77. Viasat is not a high-growth play, guys. It's a stabilization story. It's a company with real revenue and a genuine service business that was priced for failure, and then it wasn't. Now, beyond these three names, the space economy investment universe includes AST SpaceMobile, building a LEO network that delivers broadband directly to unmodified smartphones, Planet Labs for Earth observation, and a growing list of defense-adjacent names tied to satellite communications and GPS resilience. There's also ETFs. The SPDR S&P Keyshow Final Frontiers ETF, ROKT, and the Procure Space ETF, or UFO, offered diversified exposure through both carry the typical ETF trade-offs of blending high-quality names with weaker ones in the same vehicle. If the data is this clear, why did most investors miss it? The answer involves three overlapping problems: an SPAC hangover, a mental model failure, and a liquidity trap. In 2020 and 2021, the SPAC boom sent money flooding into space companies. Virgin Galactic, Astrospace, Momentus, Spire Global all went public through blank check vehicles at valuations that bore no relationships to their revenue, their technology readiness, or their market timelines. Most of those stocks lost between 70 and 90% of their value. Several went bankrupt. Virgin Orbit filed for Chapter 11 in April 23. Astrospace essentially ceased operations. The SPAC era did enormous damage to the mental model investors used for space. It trained a generation of retail investors to associate space stock with pre-revenue hype play that eventually goes to zero. That association is sticky. It didn't disappear when Rocket Lab started posting record quarterly revenue. There is a second layer. For most people, the mental model of space investment was binary. Either you own SpaceX, which was private and inaccessible, or you were settling for inferior alternatives. SpaceX was private from its founding in 2002 until June 12, 2026. That is 24 years during which the company that drove the entire launch cost revolution was simply not available to retail investors. The psychological effect of that inaccessibility is real, guys. If you can't own the best, why bother with the rest? That logic ignores the ecosystem dynamics. You did not need to own SpaceX to benefit from the sector. Rocket Labs was winning launch contracts. Intuitive Machines was winning NASA missions. Viasat was recovering. The opportunity was there. The mental model prevented people from seeing it. The third factor is structural. Many institutional investors, particularly the large funds, have minimum market capitalization thresholds for positions. Rocket Lab, Intuitive Machines, and Viasat were, for much of the past 3 years, too small to appear on the radar of the funds that move markets. Now, as they grow, and as the SpaceX IPO anchors the sector at institutional scale, that dynamic changes. Rocket Lab joined the NASDAQ 100 on June 22, 2026, and that's not a symbolic milestone. It's a structural event that can create passive fund demand once index eligibility and formal inclusion criteria are met. The investors who missed the first phase may now be entering a much more crowded and institutionally driven market, where the easy part of the repricing has already happened. The question that matters at this point is not whether you missed something, it's how to analyze the sector now that it's moved, and whether the current prices reflect a reasonable assessment of the underlying businesses. The space economy at $626 billion in 25 is forecast to reach $1 trillion or more by 2030. That's a 60% increase from where we are today. The entire market has not repriced for a post-SpaceX IPO world yet. Institutional capital that was waiting for the liquidity event that the SpaceX IPO provides is just beginning to be deployed. From a sector standpoint, the thesis is not over. It's in the middle innings. Rocket Labs at plus 300% year to date is a different investment than Rocket Labs at the start of 2026. A stock that has tripled has already priced in a great deal of the good news. The question is not whether the company is good. The question is whether the current price reflects a level of optimism that leaves room for further upside, or one that leaves you absorbing downside if the execution slips. Intuitive Machines at plus 88% still trades well below analyst price targets of $75. The backlog is real. The lunar logistics opportunity is real, but the stock is also sensitive to NASA budget decisions and mission execution risk in a way that Rocket Lab, with its more diversified revenue base, is not. Viasat is the most conservative of the three names discussed here. It's a real business with real cash flow, trading at a meaningful discount to its backlog and revenue run rate. The question is whether the Viasat 3 overhang has fully cleared, and whether the management team can sustain the operational improvements that drove the turnaround. If you're evaluating this sector, the metrics that matter are backlog size and composition, launch cadence and mission, success rates, the split between government and commercial revenue, and the path to consistent profitability. Backlog is the most important leading indicator. It tells you not just what revenue is coming, but what kind of customer is paying and on what terms. A $2 billion backlog of long-duration government contracts is a different asset than $2 billion of short-cycle commercial agreements. The profitability timeline is the key risk. Most space pure plays are not yet consistently profitable. They're growing revenue rapidly and they're burning cash in the process. That's appropriate for this stage of the industry, but it means they're sensitive to capital market conditions. A period of tightening credit or falling risk appetite can compress their ability to fund operations, independent of how good the underlying business is. SpaceX at $1.75 trillion gives you a valuation anchor for the entire sector. It allows you to do SpaceX at $1.75 trillion gives you a valuation anchor for the entire sector. It allows you to do relative value work, to ask what Rocket Lab or Intuitive Machines are worth as a fraction of what SpaceX is worth, given their respective market positions. That kind of framework did not exist before June 12, 2026. The sector was too fragmented, too illiquid, and too anchored to SpaceX as a private company that no one could price. The IPO changed that. It does not make the investments easy, but it makes them analyzable in the way they were not before. The space economy is not a future story anymore. It's a present story. Launch costs collapsed by 97% over 30 years. A $626 billion market is growing towards a $1 trillion market. SpaceX just completed the largest IPO in the history of financial markets. Rocket Lab tripled in the first half of 2026. Intuitive Machines landed on the moon twice and has a $1 billion backlog. Viasat recovered from the near failure to record revenue and 5 consecutive quarters of positive free cash flow. So the takeaway is simple. Space is no longer a moonshot narrative, guys. It is becoming infrastructure. But after moves of this magnitude, the question is no longer whether the theme is real. The question is price, execution, backlog, and profitability. The SPAC era taught investors to dismiss space stock, and that reflex cost real returns in 26. The risk now is the opposite reflex, buying the narrative after the easy money has already been made without doing the underlying work on the businesses. Backlog, revenue trajectory, government versus commercial revenue split, and cash burn. That's what separates an informed position from a sector bet. We're going to keep tracking all of this, guys. Subscribe so you do not miss the next update.